Hello friends, welcome again to alreadylate.com. Today I will discuss a big pain point of most investors and also tell you potential ways of getting rid of that pain. Friends, in the recent weeks we have seen on TV channels and read in newspapers that stock markets are at an all-time high. Sensex has crossed 40,000 and Nifty is well past 12,000. While everyone is excited and happy about this, you are most likely frustrated that your mutual funds have not shown the same kind of positive returns. Your investments over the last 2 to 3 years have in all probabilities yielded marginally positive returns or even negative returns. This often leaves you wondering whether your fund is the right fund to be invested in, whether your advisor gave you the right advice, or whether you have ended up with a wrong investment. Friends, let us first understand why your investments have not performed as well as the Sensex and Nifty. While it is true that Sensex and Nifty gives an indication of the market performance, you should know that they consist of only select large companies and are not necessarily the best indicators of market performance. Let me explain this with the help of some data from the recent past. Let us look at the performance of a few key indicators over the last few years. For sake of understanding clearly, I have taken Sensex, which consists of large companies, BSE Mid Cap Index, which consists of medium-sized companies, and BSE Small Cap Index, which comprises of smaller companies. First, let me show you what would happen if you invested ₹1,000 3 years back, that is December 2016, in each of these index. In this graph, you can see that from the period of December 2016 to December 2017, all the three lines reflecting the three indices have moved upwards. But from Jan 2018, you see that while the blue and green lines representing mid cap and small cap have been largely negative, while the red line has managed to beat the initial negativity and has continued to trend positively, resulting in an all-time high, which is what we see in the news. Now, let us look at the data from the last 2 years a little closely. What happens to 1,000 rupees that you invested in December 2017 over the next 2 years, that is till December 2019, is very interesting. Your investment in Sensex would be valued at rupees 1234, that is 1,234 today, while the investment in mid cap would be only rupees 845 and the investment in small cap would be even lesser at rupees 709. Imagine looking at negative returns while markets are at an all-time high. It is most likely that a significant part of your investment in mutual funds is in the mid cap and the small cap space. You might be wondering, why have you invested or advised to invest in such funds where the stocks are not performing well at all? To answer this, you must ask yourself a couple of questions. While investing, did you have a time horizon of around 5 years and above? Did you want to invest in those areas where the potential to generate returns is maximum despite the associated risks? The answer to these two questions, again, in most cases, would be a resounding yes. And historically, mid caps and small caps have the tendency to generate greater returns than the large caps with a greater time horizon. Hopefully, by now you have understood why your funds have not fared well in the recent years. The next obvious question is, what should be done now? Should you switch your investment from mid and small caps to large caps? Should you wait? Should you continue investing? And probably many others. To answer this, let me take you a little further down into history of our markets. The Indian markets witnessed one of its major downward trends in the beginning of 2008. Look at this 10-year chart from the end of 2007 to the end of 2016. 1,000 rupee invested in Sensex would have come to a lowest of rupees 409 in March 2009. It would have remained below 1,000, which is your invested value, for most part of the next 5 years, that is till August 2013. If the same 1,000 rupees were invested in mid cap index, it would have become rupees 280. Yes, rupees 280 by March 2009 and remained negative for almost 6 years, that is till April 2014. The investment of rupees 1000 in small cap index would have gone to a lowest of 248 rupees and remained negative till April 2016, a really long period of 8 years. Does it look bad? Indeed, yes. Am I suggesting that something like this might happen again? Not at all. The only thing I'm trying to tell you is that extreme swings are common with investing in mid-cap and small-cap companies. What should an investor who has already committed to mid and small caps do? Should you wait, or can something else be done? The ideal decision would be to continue investing despite the negative trends. I might sound crazy to suggest this, right? But seriously, this would be the best strategy. Let me again explain with the help of an example of investing during the painful decade of 2008 to 2016. If you had invested rupees 1000, only 1000 rupees on the 10th of every month for the period of 10th December 2007 to 10th December 2016, which is 109 months, do you think you would have made money by the end of 2016? Your investment of rupees 1,09,000 would be 1,56,115 if invested in Sensex, 2,353,000 if invested in the BSE Mid Cap Index, and rupees 1,78,474 if invested in the BSE Small Cap Index. The return on your investment in this worst period could still be 7.84% in Sensex, 13.17% in the Mid Cap Index, and 10.71% in the Small Cap Index. And this is not even factoring the professionalism of the fund manager, which could make the situation look much better. So while you could have invested and waited for 6 to 8 years to recover your losses and curse the markets, you could also have continued to keep faith in the markets, invested regularly, and reaped good returns. The correct strategy should also be the same. I have seen investors stopping their SIPs because the funds have been negative for a few months or a year. I have also seen investors swearing against investing anymore. I have also seen investors demanding their advisors to change the fund. But trust me friends, the best thing to do during these times is to have faith. Have faith in your investments and continue investing. As we at alreadylate.com say, tough times don't last, tough investors do. Thank you.